Good morning, everyone. We welcome to the earnings conference call of Cholamandalam Investment and Finance Company Limited to discuss the 1Q FY26 performance of Chola and share industry and business updates. We have the senior management with us, represented by Mr. Vellayan Subbiah, Chairman and Non-Executive Director, Mr. Ravindra Kundu, Managing Director and CEO, Mr. Arul Selvan, Chief Financial Officer. I would now like to hand over the call to Vellayan for his opening comments, after which we'll take the Q&A.
Thank you, Nishant, and Kotak for hosting this call. Good morning, everyone. Happy to take you through the performance for this quarter. As a backdrop, here is a quick glance on the economic environment that prevailed. The global economy during April to June faced uncertainty, largely on account of the US tariff and trade policy concerns, and also geopolitical risks in the Iran-Israel conflict. Growth outlook has been revised downwards for most major economies. In a bid to stimulate growth in India, RBI took various measures to maintain liquidity in the economy and reduced interest rate by 25 bips in Q4, FY25, and 25 bips in April, and 50 bips in June. In general, while market rates reflect the reduction in rate immediately, banks typically transmit these reductions over the next few quarters once their FD rates are reduced. Hence, the positive impact of RBI's monetary actions is expected to take effect over the rest of the fiscal year. In terms of our performance through the quarter, for disbursements, aggregate disbursements for Q1 FY26 was at 24,325 crores. Disbursement growth was muted in Q1. There was a marginal decline in the disbursements in home loans due to changes in the home registration process in a few key markets. Another contributing factor was our conscious call to exit the partnership business in the consumer loan segment. In terms of AUM, despite lower disbursements, our AUM growth continued to be robust at 23% year on year and now stands at 207,663 crores. We launched the gold loan business in Q1 of FY26 and have opened 73 independent branches in gold loans as of June 2025. Our NIM improved marginally from 7.6% in Q1 FY25 to 7.8% during the quarter. It is expected to improve in the coming quarters with the impact of repo rate cuts flowing through when banks reduce their MCLR and the benefit of EBLR rate movements accrues on the respective reset dates. Our tight control over cost levels resulted in reduced OPEX from 3% in Q1 to 2.9% Q1 of FY25 to 2.9% in Q1 of FY26. This may see some increase in Q2 due to pay hikes to employees in their annual appraisal, which is traditionally effected in July of every year. Our credit costs have increased in Q1 by 30 bips over the previous year, primarily due to stress in the market in both the auto and the consumer loan segments. Our stage 3 numbers have increased to 3.16% in June 2025 from 2.81% in March 2025. The early arrival of monsoon, significantly ahead of its usual schedule, has impacted movement of vehicles, resulting in lower vehicle utilization during these periods. Landslides and waterlogging in open cast mines hamper the earning capacity of operators and elevated stress on their ability to meet loan obligations, resulting in deferrals of payments. Concerted efforts by our team have ensured no sharp spike in delinquencies. Our provision coverage stands at 43.72 on our stage 3 assets as of Q1 FY26. PBT for Q1 FY26 stood at 1530 crores, which is a growth of 21% year on year. PBT ROA for the quarter stood at 3.1%, which is lower by 10 bips compared to Q1 of FY25. While the Q1 ROA reflects a transitional impact from the market, the underlying business fundamentals remain robust. The strategic focus on improving asset quality and continued refinement of product and pricing strategies positions us for ROA recovery in the coming quarters. The ROE for Q1 FY26 was 18.8%, as against 18.9% in Q1 FY25. In terms of liquidity, we hold a strong position with total liquid asset holdings of 17,226 crores, including GSEC and T-bills. The ALM is comfortable with no negative cumulative mismatches across all time buckets. Our capital adequacy position stood at 19.96% with Tier 1 capital of 14.31%. In terms of the outlook, with inflation softening considerably, monsoon being favorable and festive seasons commencing in Q2, the economy is expected to bounce back if risk factors such as an extended monsoon and geopolitical issues are in check. A rebound of agricultural income will result in stronger cash flows and liquidity in the rural economy. With our strong collection infrastructure, we expect credit costs to come down post the festive season in Q2. So let me stop with those comments, Nishant, and we'll be happy to take it over to questions.
Sure. We will start the question and answer session. The first question comes from the line of Suresh Ganpati. Suresh, you can unmute and ask your question.
Thanks, Nishant. So Viren, just a qualitative assessment of what explains the increase in the vehicle finance NPLs. I mean, one hand, we are seeing rural inflation being lower, but is it income levels of the truckers or freight charges not being up to expectations? What really explains this stress in the vehicle finance segment?
So hi Suresh, this is Ravi Kundu. See, in vehicle finance, mainly, two things important. One is that the vehicle capacity utilization and how the economy is actually doing well or not. So the first quarter, if you see that the industrial productions are down as compared to last year Q1. And second is that there is an early arrival of rain, which has impacted the capacity utilization in many market. So the vehicle operators are, in any case, in first and second quarter, they actually struggle for paying the first EMI, and the customer who are in the zero bucket move to first bucket, and some customers who are in borderline in stage 2 moves to stage 3. So for the seasonal effect, there is a problem, and then little bit macro side also there is a issue. So we are hoping that this early arrival of rain, if that gets over middle of the September or first week of September, then there will be a very good agriculture growth, and festivals are slightly starting in the quarter 2 end itself. So either if that happens, then we start seeing some good result coming from quarter 2 itself. Otherwise, quarter 3 onwards, we will see better result, and that will improve our performance for the year. That is what in vehicle finance.
What about other segments? When everything is gone up QOQ, the lab, the home loans, the personal loans, CSEL, everything.
So one is that we have been saying that LAP, HL, SBPL, and SME mortgage-based SME lending, where these all the divisions were the rock bottom level of the NPA. Because if you go back to 2022, the NPAs of LAP used to be 6%, where they came down to 2%. Now normalization will happen. We have said that, and their NCLs are in line with that. So yeah, so in the case of like HL, we said that it will be 0.6, and in lab it will be 0.3, and that is what is the range it is. And now when the NPAs are going up, it takes some time to get resolved. If you're going through SURFACE in the case of lab, it'll take 1 year, and then in the case of HL and SBPL non-SURFACE, in the normal traditional route of arbitration, it takes 2 years time, 2 to 3 years time. So to that extent, there will be slight increase going to be, and NCL will be in the range bound of that, whatever we have said in terms of the product line. For example, lab, it will be say 0.3 to 0.5%, HL will be 0.6 to 0.7%, and they are delivering the ROA also, whatever we have said that.
Okay, thank you.
In our case, the problem is actually, if you see that the vehicle which is actually gone up from 1.9 to 2.1, and in the CSEL where the fintech book we are running it down, there the NCLs are high range. So there are two businesses where we are seeing that we more than expected level of NCL, which is going to get sorted out by the end of the year. Quarter 4 onward, things will start looking a little better.
Oh, thank you.
Thank you, Suresh.
The next question comes from the line of Dhaval Gada. Dhaval, you can unmute yourself and ask a question.
Hi, sir. Thanks for the opportunity. Just one clarification and one question. First is on credit cost. So, for the full year, I think, sir mentioned on the channel that it should be 1.4 to 1.5%, and therefore, so should we expect this to be similar or slightly lower next quarter, and then a meaningful improvement in 2H? So that's one clarification. And second is on growth. I was a little surprised with the degrowth in home loan in terms of disbursement. Last quarter, we were thinking about 15 to 20% full year growth. So the ask rate for 2H, for the rest of the year is about 20% plus. So you still maintain that, or is there any change to overall growth thought process at the lower end of your band? Yeah, thanks.
In the housing loan, we said that this year we are not expanding, and therefore disbursement growth will be lower and asset growth will be 30%. So asset growth is actually at 30% level. In the first quarter, we've seen that, as chairman mentioned in his opening remarks, that, some of the market we are seeing that housing registration processes are getting changed, therefore disbursements are slow, which is going to be, we will come back in the quarter two, quarter three. But in general, housing loan will be around 10% disbursement only for this year, because we have not started expanding further, and we are focusing more into OpEx reduction. So that is the housing loan story. And
Right.
when it comes to the overall NCL last year we did 1.4. So it will be, if the rains get over ahead of the time, then it will be, we will get little benefit in quarter two. Otherwise, quarter two will be at similar level where we are today, and quarter three onwards we will see the reduction coming up. And if the rural economy improves after the agriculture growth picks up, and little bit improvement come from industrial production also, then obviously we will be closing our NCL nearby the number where we were in last year. Otherwise, you can conservatively take it 10 basis point increase over the last year.
Understood. And just one clarification then on growth. Since you said 10% for HL, for VF, you still maintain 15% plus VF growth. And similarly, if you can give your thought process for LAP and CSEL as well.
See, vehicle finance, we thought that, from quarter one onward, the market will at least start showing up single digit growth. But on the contrary, industry, all the manufacturers showing minus 5%. Put together, CM data is showing that minus 5% in terms of unit. And against that, we have registered 7% growth. So most of the product line, we have achieved the increase in the market share, except one or two product where we are actually deliberately not taken market share high. So we are doing better than industry. And we are hoping that this disbursement will picks up from quarter two in itself, because quarter two this time, unlike last year, this time the festival is starting from 25th September itself. So some benefit will come in the month of September and October also. So put together, the projection is that we can actually start seeing double-digit growth as soon as possible. But whether we will be reaching to 15% or not, all depends on how the agriculture growth pans out for the full year, and how the industrial production, other important parameter for GDP also start improving in the second half.
Understood. And CSEL and overall growth then for disbursement for FY26?
So CSEL is actually, because we have cut down 1,500 crore of disbursement quarterly from the fintech partnership book, and almost 500 crore disbursement we have cut down from the supply chain finance and other low ROTA product of SME. Both put together, the disbursements are down. That is what is pulling down the overall disbursement of Chola, which would have been higher by 2,000 crore, and we could have achieved to 10% growth if you consider that. So in the case of CSEL, the strategy is to basically focus on traditional and increase our CD and in-house digital lending book. So by the year end, quarter four onwards, we'll start seeing better increase in terms of the asset as well as disbursement from CSEL and CD. Parallelly, we have started, in the gold loan, and the initial start is very good. So we will see some benefit coming from gold loan with that.
Got it. Thank you, sir, and all the best.
Thanks. The next question comes from the line of Avinash Singh. Avinash, you can unmute and ask your question.
Yeah, thanks. Good morning. Thanks for the opportunity. So just two questions. The first one is this, again, just to clarify, this 1.4 to 1.5% full year credit cost guidance. this is basically on total, I mean, balance sheet assets, not necessarily on loans. So that's the first clarification. Second one, if I were to see the asset quality trends, I mean, one or the other issue started with the last year Q1 when I mean, the industry had the issue of the heat wave and electoral problems. Since then, I mean, even the H2 recovery was hoped that did not play out. So just my question is, I mean, broadly, just not one specific category, is this the new normal, I mean, in the business, the kind of a credit cost or asset quality that is seeing, and your recovery hope that for H2 now, given yes the monsoons are doing good, but then there are kind of the floods and extended monsoon problem that might creep up. The floods are kind of affecting the infra and some mining related contract and works. And on top of that, I mean, I know it's too early, but this US tariff and all that also has a kind of a linkages to certain MSME sectors. In all this backdrop, when I mean you have the CVs are as a sector is not doing well, there is a kind of a challenge from the floods and all, and then this thing, what sort of I mean again gives you hope that things will improve, the better than what they did last year, or rather they will improve at all? Thanks.
See, I don't think there's anything kind of trying to define this as a new normal, right? Which is basically, this is the environment right now. And the environment right now, I mean, the economy has been a bit muted. And so that is the situation at the current point in time, right? So, and in general, if you kind of observe the trend, kind of, usually with, with the festival season, you do see an improvement in the October, November, December quarter. So that's the only observation we're making at this stage, right? So I don't think we want to define it as a new normal, because the environment in India keeps changing, right? And kind of that is our reality. So I think that's our kind of approach at this stage.
And so that the credit cost, that 1.4 to 1.5%, that's on total assets or the loan assets?
Yeah, that is the way we calculate. And we are talking, we are not going to change the calculation. So it will be on full book. Yeah.
Okay, very clear. Thanks.
Next question comes from the line of Shubhranshu Mishra. Shubhranshu, you can unmute and ask the question.
Yeah. Hey, the moderator, also when you announce
Hi,
it,
good morning. Thanks
also
for the
announce the company.
right. Hi, this is
Moderator,
Shubhranshu from
when you
Capital. Can you hear me?
Hi, Shubhranshu. Yeah, yes.
Right. Hi.
Yes.
So, two or three questions. The first one is that after a very long period of time, I've seen the urban branches growing up to around 9% of the branches. This is almost after 8, 9 years. So, is this like a reclassification or is this a change of strategy? That's first. Second is that given the fact that we are hopeful of a better second half, how are we budgeting for this in terms of OPEX, in terms of schemes, in terms of payouts to our employees, especially in vehicle finance? What kind of TIV discussions have we had so far with the top OEMs that we work with? Thanks.
So these 75 gold loan branches which got opened up are actually in the urban market. And that is the reason it has actually increased the penetration in the urban market from the branch count point of view. There is no change in the strategy. In an overall level, we are more into the tier 3, 4, 5. In fact, 90% of the branches are in tier 3, 4, 5, 6. But as initially the gold loan branches are going to open up, they will be opening in the tier 1 and then they will move to tier 2, tier 3. So that's a thing. Second is that as far as the payouts and this thing is concerned, chairman mentioned in his opening remarks that quarter 2 is always comes with pay hike and therefore it slightly can go up. But at the same time, we are working on increasing the productivity. Vehicle finance is increasing the productivity. They are curtailing their OPEX to the same level. And other businesses are also not expanding the new branches and therefore keeping their OPEX very tight. In spite of gold loan expenses, which is branch expenses, we have increased. Our overall expenses has come down to 2.9 as against 3%. So we would like to basically keep it at a 3% level even in Q2, Q3. And with the manufacturer, we are discussing with them. They are also having a concern that the numbers are not going, and therefore they want to work very closely with us. Our market share is also improving in segments in the vehicle finance. That is because of the very, very closed engagement with them.
Right. If I can slip in just one last question, what is our strategy in terms of selection of branches for the new businesses that we have, which is CSCL, SBPL, SME? How do we go about, looking at a location and then saying that, okay, we will co-locate this particular branch with our VF branch here in this particular location? Thanks.
All the branches across all the segment, whether it is new and or old businesses, we are co-located mostly. So, but only thing is that SME are more into tier 1, CSL is tier 1, tier 2, tier 3. SBPL is more into tier 3, tier 4, tier 5. Depend upon the product, what we are doing it and type of customer, we are selecting the branches. Or most of the branches are co-located with vehicle finance branches.
Thank you so much. Best of luck for ensuing quarters.
Thank you.
Thanks. Next question comes from Abhijit Tibrewal. Abhijit, you can unmute and ask your question.
Yeah, thanks, Nishant. So two, three questions. First thing is vehicle. You said the growth of 15% will be possible if economy picks up, festive season is good. So what I'm trying to understand is beyond things which are not in our control, things which are are in our control, basically is if we can work to gain some market share. So what we are trying to understand is, are we also trying to work with OEMs which are beyond our top 2 or top 3 OEMs to gain some share with them? And the related question here is, while you said early onset of monsoons, weak economy, within vehicle, Ravi sir, if you can give some color about what is weaker? Is it new or used, or any particular segments which are weaker relative to the others? So that my first question on vehicle financing. And then the second question for Arul sir is on margins. Sir, while we started seeing some early improvement in cost of borrowings, by when? Is it going to be 3Q? Is it going to be 4Q when we are going to see a large part of the benefits in our cost of borrowings? And yield this time was a little muted. So, I mean, what was the quantum of interest income reversals that we saw in this quarter? And the last question is again on the overall growth that we are targeting this year. Ravi sir, I'm just trying to understand if you look at segments today, right? While these are smaller segments for you, unsecured MSME, which we do through CSEL, SBPL, which is micro lab. Some of these segments, at least in the last 3 months, have started showing industry-wide weakness. Most other NBFCs who've reported earlier have called out weakness in these segments, right? And where both the demand, basically growth, and asset quality, credit costs are taking a beating. So would you want to slow down a little bit in some of these segments, unsecured business, working capital loans, micro lab, SBPL, right? And will that kind of lead to we growing at the lower end of the guidance that we gave out in the last earnings call? Thank you so much.
Abhijit, let me take the interest question first. So you'll see, as I was saying earlier, the benefits has not flown in much in the Q1 or cost of funds. It's hovering at same levels because the bulk of the cost of fund reduction in the form of repo rate reduction came at the back end of the quarter. See that happening in Q2 onwards. The bank borrowings, 50% of the bank borrowings are EBLR linked. So that would see the full benefit coming through in Q2. The MCLR linked benefits will come more from Q3 onwards because banks have not started giving the entire benefit out. So you net for the full year, you should see a overall 20 basis points sort of an improvement on account of the cost of funds. We may have to give away part of it, at least 5 to 8 basis points by way of yield reductions in the floating rate book. So I would say we should see around 12 to 15 basis points net impact on NIM. purely because of the cost of funds.
Yeah. So Vijit, Ravi here. Now, the chairman has already mentioned that we are seeing that the cross segment, the economy is slow, and it is likely to improve in the second half because we are going through two issues. One is that the early onset of the rain, as well as there is a drop in industrial production, and some of the macros are not favorable as of now. But if you take the SME, there are two type of SME. Different finances have discussed about it. Our SMEs are purely a mortgaged SME, whether it is SBPL or say CSEL, sorry, SBPL, SME and LAP. Only in the case of CSEL, they have an unsecured business loan, which is very smaller. So the unsecured SME is not doing well, but secured SME, though there is a increase in the NPL, which was projected earlier itself, that it is going to go up. We are not concerned about it because it is going to get resolved through either SARFAESI or through the normal traditional route of arbitration, and our NCLs are under control as per the projected level. So as far as the SBPL or SME or LAB or even HL for that matter, the mortgage business, we are not slowing down any this disbursement. In fact, in the case of CSEL and SME, we were the first to take a decision to cut down the fintech business last year and now stopped it completely. And also we have decided to cut down the supply chain finance and also loaning SAR, which are actually low ROTA product, to increase the ROTA. Beyond that, we are not going to reduce anything. As far as the vehicle is concerned, across all product line, if you see the growth of SIAM, HCV is -6, we are +9. Light commercial vehicle +5, +5. Small commercial vehicle -12, we are -1. Passenger vehicle -1 industry, we are +2. Three-wheeler, it is flat, my industry, we are 15%. Two-wheeler is actually -6, we are +16. Only in the case of tractor, where we see that the rate competition is very high, we have taken conscious call not to reduce our pricing, and therefore we are at flat. And also in the case of construction equipment, we are similar level of the market. So we are working with all kind of manufacturer for all product segment very closely to keep our engagement level very high during the tough time and helping them to actually sail through this tough time for them actually, which is helping us to keep our numbers higher.
Got it, sir. Thank you for patiently answering my questions, and I wish you and your team the very best.
Thank you.
Thank you. Just two instructions before we move ahead. One is participants, please state your company name before you start asking questions. And the other thing is that we have a hard stop at 11:30, so just be a little brief with your questions. Kunal, your line is unmuted. You can ask your question, Kunal Shah.
Yeah, thanks, Nischint. So, firstly, if we look at the performance of the Q1, was it maybe given the environment, was it like below our expectations? And then eventually, maybe you indicated festive and maybe early monsoons getting over that would help. But internally, what are the initiatives we are taking just to make sure? Maybe have we made any credit filters more stringent, or have we enhanced the collection capabilities in any of the segments? If you can highlight that, maybe X of the external factors, what we are doing. And secondly, with respect to the overall growth, maybe 20-25%, which you have guided, you have indicated across the segments how we are looking at it. But given this kind of a disbursements now, where do you see the overall growth settling? Will it be at the lower end of the guidance at 20-odd%, or maybe even below that? And any measures which you are taking either in terms of pruning the growth or maybe boosting the growth? Yeah.
Yeah. So the calibration of underwriting and our collection mechanism is a continuous process, and it actually improves when you have a tough time. And as we mentioned about a CSEL underwriting last year itself in the Q4, that we cut down the number of inquiries, we have reduced the trade where we are giving the business loan, and also we were also very clear about it that some of the markets are basically negative in terms of repayment. So we have done it from Q4 itself. And in vehicle finance, they have been continuously improving their underwriting, models. So those are important thing. And we also mentioned that this year is actually a year of collection, not the year of disbursement. So we are trying our level best to ensure our first bucket collection is actually very good and roll forward rates are lower. And if we continue to do that, then obviously we'll start getting benefit from the quarter 3 onwards. And in terms of the loan losses is concerned, loan losses is actually not because of the current collection this thing. It is also because of the roll forward happened in the past. So our job is to ensure that whatever roll forward happened, how can we curtail into stage 2 or stage 1 in the next quarter? And that is the reason we are saying that if the economy improves, that will help us to achieve our goal.
And growth guidance?
So growth is actually what you said is right, because we have been discussing 20 to 25%, but we will be, actually trying to achieve at least the lower level of 20% without fail. Let's see that, it all depend on second half also. And we are at 23% now. So, if it deteriorates, then only it will go down to 20. Otherwise, we'll be maintaining the same level.
Thanks. Yeah, that's helpful.
Next question is from Maruk Adajania. Maruk, you can unmute and ask your question.
Yeah, hello, sir. Maruk from Novama. So, sir, I had a couple. Actually, I had only one question. It's already been discussed, but last year we were expecting improvement. Of course, there was heat wave, there was MFI, and therefore all NBFCs had indicated that they're tightening their collections, and yet the expected improvement in third quarter did not come around. So are we really seeing on ground, is that the feedback on ground? Because monsoons happen every first quarter, sometimes delayed to second quarter. But it looks like we've given up all the post-COVID recovery, right? We are back in terms of NPLs to September 22 levels in VF. So are we seeing enough on-ground factors and feel goods to assume that there will be a massive recovery in the third quarter? Because last time also that was the expectation and it did not come through, and it's kind of spilled over to the next year for different reasons. I mean, it's really very hard for us to assess then if there is any geography specific thing or any segment specific thing like mining, that will help us better understand this issue. Uh, because otherwise it's very hard to assess, right? All the gains post COVID look like being erased in the last 4-5 quarters.
So last year I said that the quarter 3 will be flat and we'll be seeing the result only in the quarter 4 onwards. It happened similar way only. And this year again, we are seeing that this is early arrival of monsoon. And that is what is created an issue in terms of the vehicle. In addition to the market itself, the environment is slow. So if the environments are slow, the results will be in line with that only. As far as your comparison between pre-COVID and post-COVID, pre-COVID level, stage 2, stage 3 is to be 10%. We are at actually 7%, still much lower than that. So our efforts is to achieve best result, but it depends on this, environment and, condition in the market.
Yes, sir. So I was not talking about pre-COVID, post-COVID. I was just talking about post-COVID in the, third quarter of 23, the recovery that we saw. I mean, the GS2 was 2.2 or something then. GS3, sorry. But anyways, thank you. Thanks a lot.
Thank you.
Pranav Tendolkar, you are next. You can unmute and ask your question.
Hello, can you hear me?
Yeah, go on.
Yes.
Yeah. Sir, so it's not just you, but there are many other NBFCs and banks have flagged two-wheeler, three-wheeler, and unsecured retail asset quality worsening. So isn't it just monsoon, or it's over leverage of retail people, like retail asset class, that is having a problem? Like how you assess it different from, say, a seasonal factor from a structural topping of leverage that a retail asset class can take? Thanks a lot, sir.
No, it is more seasonal and then also related to the economy of the country as of now, slightly looking slow. So both put together is actually impacting on the NCLs and NPL, and likely to improve from Q3 after having better result coming up through in the more mainly in the rural market, and after the agriculture growth start showing up.
Right, sir. Right, sir. So this is, I think, fourth or fifth of quarter for us for asset quality little bit worsening. So just gets me worried a little bit. Thanks a lot for the confidence, sir.
Thank you.
Thanks. Next question from Viral Shah.
Hello. Yeah, am I audible?
Yes, yes.
Yeah, thanks, Nishant. This is Viral Shah from IIFL Capital. Sir, two questions largely. One is, see, historically, we have been kind of, say, more counter-cyclical in terms of growth. Whenever we have seen early signs of, say, stress, we have tend to be more conservative, pull back. We saw some glimpses of it in FY25 in the vehicle finance segment, say, in two-wheelers, we had pulled back. You were referring to that few quarters back. Uh, Now, when and you compared the growth rates for OEMs and versus now what we are doing, are we actually seeing now signs of, say, structurally underlying environment improving, and again we are being counter-cyclical and starting to gain market share and growing aggressively on the vehicle side? That is one. Second is on non-vehicle side. I think a couple of participants have pointed this out across various and these are segments where we are relatively smaller as a lender. There we are actually seeing worsening of stress. So does that mean that now we are going to, say, relatively pull back on growth in these segments? And my second question is for Arul sir. Sir, you mentioned, of course, on the cost of fund side, how it will pan out, and maybe you may have to give on some of the rate cut benefit on the floating rate book. What about the interplay of the, say, mix change, adverse mix change on the asset side? Because we will be growing probably the non-VF book may grow a bit slower. And also, have we passed on any incremental, say, rate cuts on any of the fixed rate products also? So vehicle finance and any of those things. Thank you.
On the interest rate, on the fixed rate, we have not yet started passing on, and even if that happens, it will be more on the marginal book, and it is not on the existing book. So the existing book benefit should accrue as we tend to price the borrowings related to those lending. On the floating rate book, yeah, actually the floating rate book is growing, better. Like if you look at both LAP and HL, their AUM growth is about 30%. So they still have a lot of growth coming through, and funding for that would continue. But as we move on, in the near term, we should actually also benefit more in lab because BT in will be more, is what I look at. If there are rate reductions that are happening, both from our side as well as from the market side.
So Viral, you're right. Actually, 2 years back we said that the rural economy was not looking great, and that point in time we observed 2 years of back-to-back bad monsoon, and then we cut down our tractor funding as well as two-wheeler funding ahead of the time. But now that is not the case, and our vehicle finance is predominantly into the rural market, and we see that every year, last year onward, the monsoon is actually looking better. So that is the reason some of the products which we are not doing it in 2 years back or last 2 years, we started focusing more on that, which is showing up in our disbursement growth as against the industry growth of -5 to 7 +7%. In the case of unsecured SME, our percentage is hardly anything. So it is in the CSL which is 7%, very small to the other players. So Therefore, we do not have any problem, and we don't want to increase also significantly. There in the CSL, we are trying to increase consumer durable and our in-house digital lending book. And CSL traditional book, which is actually almost say 500, 600 per disbursement, they are remain at same level. We have curtailed the number of inquiry and in the case of say number of loan which is existing customer coming for the second or third loan. So thereby curtail the or tighten the credit norm last year itself. So we are expecting that portfolio also will start. In fact, if you see that CSL NCL from Q4 to Q1 is slowing now, though the numbers are looking very high. And from Q4 of this financial year, you will see that CSL NCL will further go down.
Got it, sir. So just one clarification on the comment that Arul sir had made. Basically, on the NIM benefit of say around 15 odd basis points from here on incrementally, does this take into account the benefit of the CCD conversion, which will come on NIMs?
Is at 7.5%, so that one it will be substituted by similar loan on their conversion. So it's not when we are growing, we are borrowing more than 1,000 crores every month. So that would get subsumed in that.
Okay, but just I was thinking from a leverage perspective, the leverage may reduce
Yeah,
a bit.
the 2,000 getting converted into equity will give a very marginal benefit, but on an overall 1,74,75,000 crore borrowing side, it may not.
Got it, sir.
Yeah.
Thank you.
Yeah, our next question comes in from the line of Shizwan Gao. Shizwan, you can unmute and ask your question.
Hey, this is Zhishuan from Schonfeld. Thanks so much for the opportunity. Just want to understand a bit more on the credit cost guidance. So let's take the higher end of your guidance, 150 basis points. First quarter, we started at 180, let's say second quarter, 170. So this sort of implied that second half, we need to go down to somewhere about 120, 125 basis points. Now, I'm just looking at this pace of seasonal improvement, first half versus second half. And compared to last year, it seems that we are forecasting a much better half on half, forecast versus last year. So just want to double check, is that what we are seeing right now? And, the magnitude of the seasonality and macro improvement, second half versus second half versus first half will be quite material. Is that the way that we should understand it?
So last year, if you see that we actually, started from 1.5 and in the last quarter we did 1.3 and the average was 1.4. So we are starting from 1.8 and that's the reason we are saying that this year, we might end up at 1.5, 150 basis point. But this reduction will be coming up only from the Q3 onwards. Q2 is still actually we have a monsoon which is going to go, and if in case we get the monsoon over in the first quarter in the first week of September itself, then little bit better result can come. So the trajectory of the NCL will be starting from 1.8. It can either be 1.8 in the second quarter or it will be 1.7.
Got it, that's clear. And lastly on the growth, sorry, the 15% vehicle finance for this full year, is that loan growth or disbursement growth?
Asset growth, isn't it?
Asset growth.
No,
That's asset growth.
asset growth is actually at 18% level. And what we said that the asset growth will remain at 18% level. As of now, disbursement is looking 7%, which is going to go up to 10 to 12% in this financial year.
10 to 12% disbursement growth for the vehicle finance. How about the overall disbursement growth this year?
That's what we are saying. No? Overall disbursement growth for the year.
Company as well.
For a company, we are at flat level as of now.
No, he's asking full year growth.
Yeah, full year.
Will be around
10%. Yeah.
10%. Okay, got it. Thank you so much. All the best for the next quarter. Thank you.
Thank you.
The next participant is Raghav. Raghav, you can unmute and ask a question.
Sure. Thanks, Nischint. I'm Raghav from Ambit Capital. Just two questions. Most of my questions have been answered. One, In the vehicle finance asset quality, can you highlight some of the broader trends across, say, the MNHCV and LCVs, and also what is used CV segment doing, and what are you picking up in terms of truck movement on the ground? I ask this because I see that your disbursements growth in MNHCV has been slowing down while LCV has been picking up. So that's the first question. The second question is, how much of the gold loan disbursements in this quarter were to the existing vehicle finance customers? Those are my only two questions. Thank you.
The gold loan is actually purely a new customer. We have not given it to our existing customer. And in the case of vehicle, we have never given the segmental data of any product line. But in general, the NCLs are higher into the small commercial vehicle product and tractor. These are the two products where the NCLs are high. Others is slightly lower. It is not that it's gone down, but it's slightly gone up across all product segment in the commercial vehicle sector.
In tractors specifically, so I think the industry has been fairly optimistic, right, in terms of growth because of the rainfall being good. So why is it that there are higher NCLs in the tractor portfolio?
No, higher NCL is actually because of the old books. The stage 2 is actually one for the tractor has improved.
Understood. Okay. Thank you. That's all from my side.
Thank you.
Next question comes from the line of Piran Engineer. Piran, you can unmute and ask your question. Piran, you can unmute and ask your question. Piran is somehow not responding. We'll probably wait for him to come back. In the meanwhile, we'll take the next question from the line of Renish Purva. Renish, you can unmute and ask your question.
Hello.
Yeah, go on.
Yeah, hi. This is Renish from ICICI Securities. Sorry, sir, just again going back to the vehicle finance business. So many players are highlighting stress in this segment. Some are saying UCV, some are saying new retail CV. But just from our perspective, we have been gaining market share. So just wanted to understand, your broad strategy about sort of why to gain market share when there is a stress, and you also mentioned that Q2 is sort of looking weak. And in that scenario, while we might continue to gain market share, but how will ensure that we are onboarding quality customers and sort of not leading to a cycle?
So one in vehicle finance, we have tightened the underwriting norm, as I mentioned, and we are working more closely with the manufacturer. So there are two things. One is that when you work with more closely with the manufacturer, you get a first right of rejection. First right of rejection means you get a best quality of customer. Second is that if your underwriting, models are tightened, then rejection rate goes up, and in spite of you increase market share, you get to good quality of customer. So that's the strategy. We are trying that only. Second is that why we are doing now, why we have not done 2 years back. 2 years back, we saw that the rural economy is slowing down, and most of the vehicle finance branches in the rural market, and then therefore the impact can be bad from the industry perspective, environment point of view. As of now, what we are seeing, the rural economy it is improving, and it will be further improving after this monsoon gets over. That will help us to basically maintain our quality in time to come.
Got it. So, just a clarification. So you are saying our rejection rate in vehicle finance currently, let's say, would be higher than 2 years back?
Higher than the past.
Yeah. Okay. And we are still gaining market share at dealer's point.
See, as far as all these products are concerned, small commercial vehicles and all, we have tightened our credit policy. So in terms of the acquisition stage itself, customer acquisition stage itself, the filtration is going in. And plus, when you move
when you are in the first right of refusal at major counters, we are not active across major manufacturers. That is helping us in acquiring the best of best customers. So we are not running after that. Another thing is that when the market is looking bad, manufacturers are also down. And at that point in time, if they are coming to us, that is the best time to basically gain the market share. When market is doing very well and you start gaining market, that is not the great idea we have seen.
Got it. And so basically, we are gaining market share at the dealer's point and not, when gaining market share by expanding the distribution. I mean, how one should look at this?
Both happening. Distribution is already been continued to there, as we mentioned in the past, that our resident locations have gone up to 700 towns, where we will have the branches in time to come. So the network is more than 1,613 branches.
Okay. That's it from my side, sir. Thank you and best of luck.
Yeah, next we are moving. We are checking back with Piran engineer. Piran, you can unmute and ask your question. Okay, there is no response from his line. We are moving on to Hardik Shah. Hardik, you can unmute and ask your question.
Yeah, thank you for the opportunity. Can you hear me?
Yes.
Perfect. Sir, my first question is on the asset quality in the vehicle finance space. Given that we have seen elevated stress for a few consecutive quarters, how has the loss given default trended across product types, commercial vehicle, used vehicles? Is there anything different that you are seeing versus historical trends?
LGD is remain same level as of now. There's no change in LGD. Loss on sale on the asset, whatever we repurchase, it is 32 to 35%. Varies from product to product.
Understood. Okay. And sir, my second question is on growth. If this slowdown was to sustain in vehicle finance, are there any other levers that you think you could pull to meet your AUM guidance of 20 to 25% or the lower end of 20% growth guidance? How are you thinking about it?
You're saying in
disbursement growth.
vehicle finance, you're saying if it doesn't go up, then how will you achieve 20% growth?
No,
On
he's saying
asset
if
growth, yes.
At an overall level?
Yes.
Obviously, if one business goes down significantly, it will impact on the overall growth. But our hypothesis is that the vehicle finance will be there at 17-18% level and mortgage businesses will be there at 30% and CSEL and SME CSEL business will be slightly lower. With that, we are reaching to 20 to 22% asset growth. Anything goes down, it will further reduce the overall growth.
No, so you are saying that you are okay with achieving lower growth versus guidance if vehicle finance were not to improve, not grow significantly on other segments. Is that understanding correct?
No, vehicle finance, we said that our disbursement is at 7% level in the Q1.
Yeah.
And here our disbursement is going to go up only because we are seeing that now the manufacturer and dealers have started stocking the vehicle for and preparing for the festivals. So with that indication is that it will go up to 10 to 12%. If that happen, obviously vehicle finance disbursement remain at same level.
I think the question is if vehicle finance growth does not come.
Yeah.
Then what happens, right? And in general, kind of our perspective has been that we do have the opportunity because of the overall portfolio to see if other businesses can basically kind of fill up some of that, drop. So is that your question, Karan? So in terms of,
Yes.
so that's basically how, so that's how we would manage it. So if vehicle finance continues to be muted in the second half, then we will obviously look at mix from other businesses like lab, home loans, and some of the other businesses.
Got it. And my last question is on the MSME versus commercial vehicles or vehicle finance overall. We see profitability trends in MSME has improved, while that for vehicle finance has come off. So what is it that you're seeing differently in SME versus vehicle finance space? Are we going down the risk curve there, or how should we think about it?
Mainly, lever is only one here in the between them. MSME, all businesses are basically a secured business, and their asset-backed MSME has a lower NCL. And surface benefit is there in order to get back, and those are appreciating asset. In the case of vehicle, it is a depreciating vehicle. If you repurchase, then obviously the NCLs are high, and we are at higher level of NCL, which is actually dragging the ROTA of vehicle compared to the auto ecosystem what we are given versus the SME ecosystem. OPEX is also high in the case of auto ecosystem as compared to SME ecosystem, because the ticket size in the SME is much higher than the auto.
Understood. Okay. Thank you. Thank you for your answers, sir.
Thanks. We move to Abhishek Murarka. Abhishek, you can unmute and ask your question.
Yeah, hi. Thanks, Nishchin. I'm Abhishek Murarka from HSBC. So the first question is that in CSEL, how much of it is unsecured business loan? And can you give some cuts in terms of, ticket size, geography, customers, where you're seeing stress? Is there anything specific to note over there? And how much of the CSEL is actually partnership based, and by when does that run out? So that's my first question. I'll just come back for a quick second question as well.
CSEL partnership, 2,500 crore. Balance is between the CSEL business loan, personal loan, professional loan, and a CSEL CD and D2C. That's all unsecured, isn't it? And everything is unsecured. Entire CSEL is unsecured. Only that CSEL is only unsecured. So that's a 7% of overall book.
Yeah. So outside of the partnership business, are there any particular pockets of stress, or it is across all these different segments?
No, one is that the CSEL, business loan, which is having little higher NCL than what we expected. And that's the reason we started, cutting down the number of inquiry and also reducing the existing loan to give the second loan or third loan, which is basically done in Q3, Q4 last year itself. But the disbursements are at same level what we used to do it. Earlier last year we used to do 500 crore. Now also we are doing similar level.
Okay, so the CSEL business loan is how much?
CSEL business loan is almost 7,000 crore. 7,000 crore.
7,000. Okay. And within this 7,000, do you see any particular geography, like, maybe Karnataka, Tamil Nadu, or anything particular in terms of ticket size where the stress is concentrated? Some cuts will be helpful to understand the problem.
Okay, across the country, in the CSEL business loan, actually the problem was where the customers have multiple loan. So that was around 5%. It's not concentrated in a particular geography. It is spread across.
Okay, 5% of the 7,000 crore book.
Yeah, are having a multiple loan.
Multiple loan. Okay, that helps. Okay. And the second question is, when I see your vehicle finance slide, the assignment part for this quarter is just 6 crores. It was 9 crores last quarter. It's been coming off. So what is the plan there? Are you looking to assign more vehicle finance going forward, or is this just a product you don't want to do? How are you looking at that?
See, actually, we have not been doing assignment for a long time. And of late, some demand came from one specific bank which, wanted lab book. And since we have a long and a large relationship with them, we have started doing some assignment over the last 2 quarters. So that has been restricted to lab. So we don't want to go around seeking assignment, especially in vehicle finance or other books. Vehicle finance, we do a lot of securitization. That is not shown separately because that is coming as part of borrowing.
Yeah.
You're not seeing that.
Understood. Okay. Okay. Thanks so much and all the best. Thank you.
Thank you.
Thank you. We'll take the last question from the line of Nidesh Jain.
Thanks for the opportunity. I'm Nidhesh from Investec. So 2 questions. Firstly, in your products, do you see cross-sell opportunities, synergies of cross-selling your products to same customer? And are you looking the business from a customer lens or from a product lens? And secondly, how do you benchmark yourself in terms of technology with your peer group within the NBFCs, especially the top NBFCs?
So the cross-selling as of now within vehicle finance we are doing. So around 25% of disbursement is actually coming from the existing customer, where the vehicle customer is going for second loan or commercial vehicle customer is going for car loan or two-wheeler loan. As of now, we are not cross-selling LAP against vehicle finance or vehicle finance against LAP. So that's cross-selling across the divisions are not happening. It is happening within the division only, restricted to within.
It happens like when the customer inquiry comes, we do that. It's not that we don't do those products, but
we don't drive that.
We don't drive it as a cross-sell product, but it is naturally happens because
one of the things we started from an analytics perspective is looking at the propensity of customers to kind of, so we're taking each of our customer data sets and looking at their propensity and interest in buying other products that we would start cross-selling. So we're definitely making that transition from a product-based view to a customer. And I think that that's a shift that we're beginning to make.
So we are also using our internal bureau data, like our existing bureau data to kind of leverage on the cross-sell as well. Some products.
Yeah, but the opportunity in the cross-sell is more into if you do CD and then give, say, personal loan, that opportunity is more. So our CD book is very small. And our digital lending, as of now, we are doing 100 crore is actually coming from the existing customer.
Sure. And on technology, how do you benchmark yourself?
So I think we are having a best IT team. I think we can say that, and our most of the loan origination system is, internally developed. Fully, we are relying on the LMS being supplied by very top-notch IT company, and all other subsystems are also developed internally.
Okay, sir. That's it from my side. Thank you.
Thank you.
Thank you very much. That was the last question for today. We thank the management for providing us the opportunity to host this call, and we thank participants for joining us today. Have a nice day.